Welcome back to Look the Trader, and today we have Matt Water here for an interview. And could you just please introduce yourself to the audience and talk a little bit about your background?
Sure. Yeah. Well, I'm Matt Warder. I run a solo consultancy called Seawolf Research, whereby I do kind of management consulting to the broader mining industry. I'm also publisher of thecoaltrader.com, which provides news and analysis of global coal markets. It's really, I mean, in the world of, I'm going to put this in air quotes, research that's out there. The coal trader has really become one of the only independent voices of the industry that isn't, big and corporate and been around for a long time. So we have the flexibility to kind of change views and, say what we think a little bit more freely, I think, than other publications do. And also, yeah, it's good feedback for the ecosystem as well in that regard.
Yeah, it is definitely a good website to use, especially for coal and all the other things. And since you already talked about coal, I just wanted to ask you what your current view of the met coal market is, and perhaps could you also talk a little bit about thermal as well?
Sure, yeah. So the met market right now is it's been a market in flux for, quite a few years now, really since post-COVID. Prior to that, the general sense was that, steel production in China is going to flatten out. India is going to ramp up, but there's really, demand for everything is going to be relatively flat. There's not going to be a really growing need for coking coal. And that's kind of changed because one of the things that happened during the pandemic was mines that shut down, some of them didn't come back. So the elasticity of supply where it was changed. And as a result, I think we just now this past year got back to about the same size of market as we saw in the pre-COVID years in terms of overall tonnage. We're really in the past 2 years in the wake of the Russia-Ukraine war, trying to find an equilibrium point. Like, where is the kind of new normal for met coal markets? In days of yore, it was about $150 a ton. That was kind of the equilibrium point around which every financing was done around, it's the center of the cost curve or 90th percentile cost curve. Now that number, I think, is probably starts with a 2. Exactly how it shakes out at 200 versus 225 versus 250, 275. I think that is yet to be determined over time, but that's sort of what we're in the process of finding out. And even just in the last week, the market view has gone from relatively bearish because China isn't particularly strong coming into the back half of the year. India had elections that rendered it, sort of, we'll say, sluggish to contract new tons and those sorts of things. There was a mine fire over the weekend at Anglo's Grosvenor mine, which took about 3 million tons out of the market. And that's all it takes to kind of get, a run jump started these days. That's how sensitive supply is. And there's not really any other tons that can come out and replace it. So, to be, a little bit more concise, I think the outlook for the met market is relatively solid. Most of, the major players in the world make pretty good money at these price levels. And that's probably going to be the case going forward until there's some other factor that becomes readily apparent that isn't here at the moment. On the thermal side, you have kind of similar dynamics. The same sort of price supply inelasticity evolved in the post-COVID years. However, thermal coal has a big competitor in the market, and that's natural gas. So the lower that LNG prices and natural gas prices go, thermal coal will move in sympathy with that. I think in terms of thermal coal, we think the market probably bottomed last year, and we're kind of going to coast along at these levels alongside LNG and gas. So that's really what's going to set the market, and we're going to be, I think, in the coal industry more price takers in that regard going forward.
focusing a little bit about the met coal side of things, especially demand, what is your view on the potential substitution of met coal through the use of hydrogen or other methods, be it, let's say, as an arc furnace, an electric arc furnace?
Sure. Well, there's kind of two sides to that coin. Um, uh, with regard to hydrogen, first of all, there is no mature hydrogen distribution network that exists in the world,
Mm-hmm.
and any incremental demand that we add to it via steel is going to draw on a pretty finite supply that will have to adjust itself, and then there's the problem of getting it to market. So I think that takes a while to just work itself out in general. From a secondary perspective, anytime you introduce hydrogen to heat, bad things can happen. So,
Yeah.
for lack of a better turn of phrase, and then also the fact that the process of reduction with hydrogen will create water. Will also mean water plus blast furnaces in particular. Water plus blast furnace equal boom. So,
Mm-hmm.
I from a safety perspective, I'm not uh, you know as well versed as others who are on the more technical side, but I have yet to see a forecast that accounts for that or that addresses that. I
Mm-hmm.
think we'll have to do that incrementally over time. We'll figure it out eventually, but I think
Mm-hmm.
it's going to take much longer than 10 to 15 years. At the snap of a finger. You can't really do that. The second part to that is there's absolutely going to be in developed economies a transition from traditional blast furnaces to electric arc furnaces.
Mm-hmm.
As more scrap becomes available in your market, you have the option to take that and reduce the need for further blast furnace demand growth. The United
Mm-hmm.
States has been in part of that transition for a long time, and I would use the U.S. as an example. We still haven't
Mm-hmm.
converted 100% because the world continues to grow, and you can't recycle your way to growth. You need more virgin material. You need to go mine more. We're going to need more cars and more houses and more white
Mm-hmm.
goods and more, air conditioners and all those kinds of things going forward,
Mm-hmm.
not fewer. So it's, my sort of view is I think the transition to electric arc furnaces will probably take time, especially in China, longer than most people
Mm-hmm.
think, and the same with transition to hydrogen. I think both are pretty interesting. There's also some questions as to whether or not hydrogen direct reduction would allow more impurities to be pulled through the
Mm-hmm.
process on the iron ore side, more silica, more alumina. I don't know that that's necessarily the case, but I've heard that enough to know that's also kind of a sticking point for some folks as well. So.
Mm-hmm. In terms of CO2 emission, would you say then that hard coking coal could be used as sort of a stepping stone towards reducing CO2 emissions, especially in the production of steel?
In what way do you mean hard coking coal uses a way toward reducing CO2 emissions?
Compared to lower quality of met coal, such as being
Oh,
semi
right.
hard coking coal and lower levels, essentially.
Gotcha. Yeah, obviously the hard coking coal is a more efficient fuel. It's a more efficient reductant. It makes better and stronger coke, so you get to use less of it. But I mean, the problem is cost, right? So as
Hmm.
long as the supply chain allows for the use of as much hard coking coal as you can get, and it's available in the market, that's all fine. But the limited availability of supply, coupled with just the fact that sometimes steel production is unprofitable, kind of
Hmm.
limit the optimization of that side of the equation, if that makes sense.
Hmm. And met coal, sort of, we have let's say, sort of a super cycle going on in terms of M&A. What is your current view about it in the met coal space? Because it's essentially not bringing in new supply, but it's rather just replacing ownership.
Right. I pause at the word super cycle because super cycle implies that there is,
Hmm.
this rapidly increasing demand component. And that's really not the case for met coal. Demand is increasing, but it's increasing pretty modestly. The difficulty is on the supply side. We don't have access to finance, so nobody's financing new mines. Certainly, nobody's financing new mines that are way up on the cost curve to bring incremental production into the market. And nobody is really trying to find new replacement tonnage, as opposed to they're just kind of swapping horses for courses and optimizing their own operations. But you're not getting any, future additional capacity to all come online at the same point in time because of perceived risks that are involved in the market, and an unwillingness for for traditional finance entities to participate. That's kind of how I view the super cycle side. With regard to the M&A, obviously there are companies around the world that would like to get coal out of their portfolio, for lack of a better term phrase, right?
Yeah.
Anglo has been pretty vocal about that in the past. And then had recently just decided to regroup and see what they could offer to the world. And then the Grosvenor mine fire just happened, which has probably reduced their asking price by a couple of billion. So, the M&A side is going to really take time. What is clear is that producers are looking to the top tier assets as the ones that they want to control. And Glencore Tech, obviously a big, the biggest so far, transactions to take place in that regard. I think you'll see some additional M&A, probably in the U.S. As well. There are some synergies, or should we say, complementary skill sets that you could probably take advantage of by pooling resources for two companies together. There are some regions that could benefit from consolidation too. I mean, not just on the met side, but also on the thermal side, to kind of pool risk in one entity as opposed to several, and then see what other ways forward there are. But in general, I think the guys in the U.S. are, shall we say, happy to have pretty clean balance sheets. Most of them are kind of focused on the tasks at hand. I think there's some ideas probably being kicked around, but there's not a rush to it, I guess, is probably the best way to put it. We're going to see some. There's definitely been some activity here recently, some to the positive, some to the negative. We're going to see more going forward, but I don't think there's going to be a mad rush to consolidate like there was, say, in the boom from when I started my career in like 2008 to 2014 or so. I don't think that level of desire to everybody get together is quite there yet.
And since you already talked about sort of the supply side of things, and that it is mostly the issue sort of when talking about the spot price, what would you say is sort of the long-term pricing? Would you say it's sort of more flatline around, let's say, as you already commented before, 200 to 250 with some spikes here and there, or how would you see it generally?
That's kind of how the market has always gone, right? In before times, prices would move between call it 125 and 175, with occasional spikes to 200, 300, and then it'd go right back to where it was before. Now we're trying to figure out that new baseline. And like I said, whether it's 200 or 250 or 230 or 270, those numbers are all kind of arbitrary. It's when we have, disruptions in supply, like we just had over the weekend, you're going to see more times in the future. I think the price going up to 300 and above, and if it's a really big mine, if it's a really big supply disruption, that's when you get the 4s and 500s and 600s available, because as long as steel price supports, if you need that extra ton of coal in order to meet your downstream production needs, you pay whatever you have to, as long as your cost structure supports it. So steel prices are kind of a limiting factor on the top side, and as that market progresses forward, which is challenged at the moment. China has incredibly high steel stockpiles. that's going to get exported out into the market and probably keep global prices subdued for some time. Similar to what happened in 2014 to 2016, there's a lot of boron added steel that they dumped on the market. Prices for steel weren't particularly good during that period, but you get through it. You churn through that inventory, and there's another side to every cycle. And I think when we look at this one in retrospect, in 20, 25 years or something like that, we'll kind of look at the lack of finance and the high labor inflation pushing the bottom of the market up, and then steel on the other side with downstream pressure from consumers. There's only so high that steel can go. So those two factors are kind of going to squeeze, I think, this range over time into something that resembles a pretty decent price for producers, but a less volatile market than we've had here recently.
And then how would you sort of play the met coal market in terms of looking at public companies? What is sort of the most exciting to you? Is it the producers, whatnot?
Yeah, I mean, for me, it's more. I think met coal has a more stable outlook, and the pricing is going to be better. The margins are going to be better over the longer term. Thermal coal is definitely going to have a couple more moments like we had in 21, 22, because natural gas supply kind of grows in these spurts, right? And then when capacity gets readjusted afterwards, coal is the capacity that goes away and doesn't come back. So I think we're going to have another moment in the sun for them. But the met side, I think, is going to be relatively consistent. In my position as an investor, there are two aspects to the publicly traded universe that I think really matter. The first is there's a royalty regime in Queensland, Australia, that at very high prices becomes darn near confiscatory, and
very
it pulls
expensive.
a lot of the it pulls a lot of the profits out of those Australian producers. Be it Peabody or Whitehaven, or Stanmore, or Yancoal to a lesser extent on the met side, but like those are all great companies with great cost structures, and in these kind of middle price environments, they're fantastic. But in order to capture the upside beta of any of those market prices, I think you have to look to the U.S., which tend to be a little bit higher up on the cost curve and therefore a little bit more volatile anyway, but have really clean balance sheets, and they don't have the same royalty regime because it's a cost. They don't have the same royalty costs, variable royalty costs that Queensland does. So in periods of $600, $500 met coal, the U.S. guys are probably going to make more money than the other guys. And we just happen to have two really good pure play metallurgical coal vehicles here in the U.S. in Alpha Metallurgical Resources, ticker AMR, and Warrior Met Coal, ticker HCC. Like those are the the kind of two barbells that I've been approaching the market with for years now, and that's worked out pretty well.
And as sort of a coal analyst, what is your opinion on ESG? Is it, in terms of, at least in the met coal space, rather hindering progress in terms of, let's say, achieving CO2 neutrality, or how would you say is it?
Well, I mean, so I think first of all, let's probably separate the idea of ESG from its execution, right? The idea behind ESG, be a good steward of the environment, be socially conscious, practice good corporate governance. I mean, of course, if you're running an operation, like you want to do all those things. Like, who would be against, taking good care of the environment? You don't want to set forest fires and do all that stuff. So, of course, those are things that people should do. Of course, those are goals that we should have. The difficulty comes in the execution and the practice of it. And we have to realize that policymakers, whether they be here in the United States or in Europe or wherever around the world, doesn't necessarily matter. Policymakers aren't experts on this particular subject matter, right? They know this is a goal that they want to do, but instead of really consulting with a variety of experts from all sorts of the industry to figure out how
Mm-hmm.
you can effectively phase out, coal-fired generation, how long that would really take. Instead, they're just issuing these decrees from up on high, and then the market has to adjust to
Mm-hmm.
it. And then the net result of that is the supply inelasticity that I talked about earlier. Once those mines go away, they don't come back because you've regulated away the demand. Well, but you
Mm-hmm.
didn't replace it with anything, and that's the issue. And you can't take baseload power out of the mix and replace it with intermittent power, because that's not how you balance a grid. The grid has to have a constant charge on it, and solar ramps up during the day, and then there's a period where it goes down, and wind has to ramp up during at night,
Yeah.
and sometimes that doesn't happen. So
Mm-hmm.
the fact is, I think policymakers are finally having a come to Jesus moment about the fact that, well, we do need baseload generation, and they're starting to turn to nuclear, which
Mm-hmm.
is good. That's fine. I don't necessarily have a problem with the idea. It's just you can't go from step one to step 100 like that.
Yeah,
You have to go
exactly.
through step two, step three, and step four, and create a transition that occurs at a reasonable pace, where you're accounting for the raw materials that you need in order to build your facilities, for the raw materials you'll need in order to make up the individual generation units. Whether we're talking about electric vehicles, or whether we're talking about power gen, whether we're talking about adding hydrogen
Mm-hmm.
into the steel mix, like, it's a transition, and people need to
Mm-hmm.
focus on the transition part so that we don't break something in the process
Mm-hmm.
of trying to achieve what is not in and of itself a terrible goal.
Mm-hmm.
And you have to be honest with people about what that looks like.
Mm-hmm.
And that's the thing that I'm not really seeing from the top down. I think it's justifiable project for Western economies to indulge in, but, like, you got to show me how. If you don't show me how,
Mm-hmm.
I can't help you. That's kind of where I stand on it. So the other flip side to it is that it has become a box to tick
Mm-hmm.
for corporations, and so they'll virtue signal by just essentially sometimes wasting capital on a project that doesn't really have anything to do with their bottom line, but it might help their stock get a 0.5x re-rate or something.
Mm-hmm.
I don't think that's necessarily productive use of capital either. Like,
Yeah.
I just prefer we set policy that's reasonable enough so that the market can help us along, and that also it doesn't discourage folks from participating in any kind of mining finance, be it coal, be it copper, be it lithium or rare earths or what have you. We're going to need all of it in increasing
Mm-hmm.
proportions, some more, some less, over time. So let's allow that to occur so that we can achieve our goals in a reasonable time frame.
Mm-hmm. Yeah. And just to switch gears up a little bit, what
Sure.
commodities are you currently most interested in besides coal?
That's a good question. I look at the back half of the year. I don't necessarily think demand for oil and gas is going to go gangbusters. Uh, I think it has to be copper, even though we're
Mm-hmm.
kind of in a bit of a lull in the market here, just because especially with the AI data center build out projections, and a market that's already to some degree in deficit, depending on which part of the year you're talking about, and also a lot of supply inelasticity in the market as well. Right, we haven't financed a lot of new copper projects. There are some
Mm-hmm.
spectacular exploration projects in South America, Vicuña District in particular, uh, but they're not mines yet, right? And then
Mm-hmm.
Panama, in all their wisdom, protested the Cobre mine for First Quantum.
Yeah.
That permit got revoked, yanked out 1 or 2% of global supply, and price went to five something before correcting. So I don't. If we're going to rapidly deploy AI, like everybody seems to suggest that we will, and I think power is probably going to be the
Mm-hmm.
limiting factor for that ultimately.
Yeah.
But that requires a whole heck of a lot of copper, for the connectivity alone. and we're not positioned from a supply side to be able to satisfy that. I don't think, at least in
Yeah.
our current iteration of markets and projects and those sorts of things.
Yeah, we just unfortunately don't see a lot of interest from the majors in any other commodity, be it gold. There's just no interest currently by them to either develop
Yeah,
mines or even fund projects.
yeah,
Unfortunately.
and that becomes the problem is that M&A is consolidation is a great tool. You get to manufacture an economy of scale. Sometimes there are synergies on cost that you can save. That's great, but it doesn't grow production. You're just adding to what you're robbing Peter to pay Paul. You're taking production from one guy and adding it to your own, but the net doesn't really change. So you can't grow through M&A as a global market. You actually need to do the hard work of finding deposits, bringing them into production, and getting finance motivated to participate. That's really the trick. And I know that there's going to be a reality check here at some point in time, but it still just baffles me that we can advocate for all these policies that will increase power demand, that will increase copper demand, that will increase these mined materials, and yet we can't also, as a culture, allow for the fact that we got to produce some more stuff. It's still a really frustrating conversation to have sometimes.
Yeah, it's a bit concerning as well.
Right.
Yeah, yeah, and as we're sort of coming to the end, is there something that you want to highlight or perhaps talk about?
I think on the coal side, just the awareness that the market is going to be pretty good, I think, for a relatively long time. And even though the trade, the bulk of the trade is behind us now, from 20 to 21 to 22, and then buyback fueled craziness on through 23 in the early part of this year, that part of the market story is behind us. But the margins that producers will be able to make over the coming years, and met coals usually runs in about a 5-year cycle. You have two kind of years. You have one probably pretty bad year, and then one screaming awesome year. And you average that out, and over time, it looks way much cheerier and happier and nicer in terms of free cash flow generation now than it did 5 years ago, 10 years ago. So now I kind of view these companies as compounders. So they're going to take the free cash flow that they generate and either funnel it into growth, which is what Warrior Met Coal is doing, or funnel it into buybacks, which is what Alpha Metallurgical Resources has been doing. And those are the two ways I think that I've kind of turned from riding the beta of this wave here over the past few years to these are kind of like just hodl stocks at this point in time. And at some point in time on down the road, there's only so many shares you can buy back. You'll either have to, when you get that low float, you'll either have to switch to special dividends or take it private, or there'll be some other incentive for, for whoever holds those last shares to part with them for some reason. So, that's I think the thing that we need to communicate mostly to the investor class. It's still, even here at this point in time in the trade, it's a good investment. It's just a different kind of investment from what it was just a few years ago. And I guess other than that, the thing that I try to do more so than anything else, being, kind of the only resident liberal, I think, in the coal industry, is just to kind of point out that it's not some like big evil commodity at all. It's just it's a tool that we use to generate power and to make steel, and that's pretty much about it. To make cement, to do some other things with, to make a little bit of heating here and there, pulverized coal injection. I mean, there's a lot of uses for it, but it's a necessary means to an end relative to the position that we're in, and demonizing the industry from a public relations perspective, as has been done, I think, for the last 10 years, it doesn't just do the coal industry a disservice, it does the world a disservice to some degree. And so, you have to be able to hold in your head two different thoughts, one of which is, Okay, well, I would like to, reduce my carbon emissions over a longer term. That's fine if that's the goal. But again, like, understand that this industry that's here now is here to help, not to hurt us, right?
Hmm.
We need them to generate power. We need them to, make steel during this period of our lives. And so instead of working against them, have the industries, I think, more be involved and work with them on what that kind of transition will look like. Because,
Hmm.
right now we're in a situation where, India is rising as China is plateauing. And it doesn't matter where you look out into the future, there's going to be that continued dynamic. Somewhere in the world is going to grow as one begins to plateau.
Yeah.
And, it's my personal view that all of those, members of those sovereign nations, have the inalienable right to get, more prosperous, to have more jobs, to be able to kind of,
Hmm.
move up the socioeconomic ladder into, and be accepted by Western economies to do that. And I think it's incumbent on Western economies to allow that to happen. And
Hmm.
the way that they can create space for that is by ordering their own transitions in a more logical and achievable fashion. So that's kind of how I look at the whole thing. Like there's it's commodities don't really have a political side. There's no
Hmm.
coal doesn't care what party is mining it. You know, and the same
Exactly.
thing. Yeah, and the same thing with utilities. Like it's here to serve a purpose. It's here to do a job. We know how to use it. We know how to transport it, ship it, and mine it. As safely and responsibly as we can. With every mining operation in the world, there's things that can go wrong. As
Hmm.
we had the mine fire over the weekend. But that's the nature of the business, and it's not inherently good or bad. It's just a job that we have to do in
Hmm.
order to achieve the future that supposedly we want.
Hmm.
So, that's, I don't spend a whole lot of time talking to advocacy groups or anything about like that in particular, but, that is something I try to, you know, expand upon in interviews whenever I get a chance to do it.
Hmm.
Because it's, I don't really view access to energy as a left wing or a right wing phenomenon, or access to upwardly mobile socioeconomic
It's
mobility.
it's a
Like,
basic need, right? Just like water
yeah,
and food.
it is. And I mean, 250, 300 years ago, when our founding fathers, sort of started this country, that was kind of the idea.
Hmm.
So, I think we've come to this like fever pitch, with regard to natural resources that, all the parties that be need to take a deep breath, take a step back, and see how everybody can work together to achieve a common goal.
Hmm. Well, Matt, thanks for your time. It was great talking to you, and have a great day.
All right, sounds good. Appreciate you having me on, Lucas.